complicated. This is all within the same process that real estate is in. I promise you guys that it's going to be real simple, easy to understand. There's going to be a lot of different questions that are asked. I want you guys to know up front and personally, there is no such thing as a dumb question, okay? My goal here is to get you a little bit more educated about mortgage protection as a whole. It's a complicated word normally. So I want you guys to get acclimated a little bit more to it. I know that we're going to be live on there. I know that we're going to be taking some content there, but the whole goal with the content as well is maybe to create like a 5-minute snippet that you could send to your clients and say, hey, I just want to make sure that you're good in this category of life when it comes to mortgage protection, okay? This sheet that was passed out to you guys, damn, you're right in the sun. You're gonna be, okay, cool. So this sheet that was passed out to you guys here pretty much says it all. You know how you have a client and they have a family, right? Normally when they have big goals, they want to go and purchase a home, don't they? Right? That's the whole reason why we're here. They get a pre-qual, then they go and look for real estate. Then they go and say, oh man, what if something happens? I want to go get some income protection. Normally as a financial planner, I let the potential client know this is completely backwards. Like you should be budgeted on where you want to be in the future before you go out and buy a house. Now, I'm speaking to a real estate group, so of course I'm on your side. I'll fit in wherever you'd like me to, okay? But normally when you're doing like the analysis for the client, you're asking them about mortgage protection. Where are you at with respect to mortgage protection? And they go, huh? You know, they don't really know about that stuff. So it's kind of like backwards. They should be doing like where they want to be in the future. I want to retire by the time I'm 65. I want to make sure that my kids are going to college. I want to make sure that I have the Tesla versus the gasoline hog. I want to make sure about all these different things that are supposed to be in order. But just like Americans, 95% of them, they go in guns blazing and they're like, I want the pretty thing and I want to get into debt and I want to afford it somehow. So again, I'm speaking to a real estate group. So wherever we fit in, terrific. We'd love an opportunity to help your potential clients with mortgage protection, I call it, okay? So we're going to be going through both term and permanent options of mortgage protection. On the back here is this cutesy little face right here. This is the contact information that you're going to be going towards. You're going to be contacting this young lady right here for your mortgage protection needs. Okay. Now, when we're closing, this is not my first rodeo. I've spoken to several real estate groups. When we're closing the escrow on the transaction, we want to ask, hey, what kind of mortgage protection do you have for your family now that you've invested into one of the bigger assets in your life, potentially the biggest asset in your life, in your family's life, for generations to come, okay? That's number one question. Number two question you're asking is, how is your home now protected from probate, okay? So I'm gonna chime in on living trusts for like a brief second, okay? Yes, ma'am.
So this mortgage protection is different. So when we do get a home loan and all that, and if it is under 20% of value, isn't it automatically in the MIs are already in there?
Love that question. That's called PMI, right?
Yeah.
Yeah. Mortgage protection that I'm talking about is, God forbid you go down with a stroke, Mr. Client. If you go down with a stroke, what happens? What's your plan to pay the mortgage tomorrow? It's an uncomfortable question, but if they're self-employed, like all of us are, they're in trouble.
Right.
Like, how are they paying the mortgage? How are they paying the car? How are they sending little Johnny to college potentially? The number one cause of divorce is finances. It's not because someone cheated on them. It's finances, number one, okay? So we're saving people from divorces. We're saving people from financial catastrophe, okay? So the mortgage protection is a fancy word for life insurance or income protection, okay?
So it's an additional add-on from that PMI.
And majority of the time, they already have, not even majority of the time, some of the time, they have income protection, okay?
They do.
Sure. So original question is, now that you've purchased your most valuable asset in the near future, I want to make sure that you have mortgage protection and probate protection. Probate protection is your living trust. Mortgage protection is your income protection, life insurance, okay? Now there's 3 sorts of income protection. There's number 1, disability. Number 2, illness. And number 3, unfortunately, death. Majority of people, they're around here peddling life insurance. Who wants to die to use it? Not me. I don't want to do that, right? But if I go down with the disability, let's say I do hair, get my hair done. So let's say I do hair and I lose the ability to use my hands, my money makers. Can I make money anymore? No, that's a huge prospect for you guys, okay? So as real estate professionals, normally you're just out going for the real estate. Would you like to buy, sell, or invest in the real estate? Clients normally are open to that until economics hits them in the face. At this point, bigger question is, how is your home protected from probate and income protection, okay? So going along those lines, if I'm talking to an entrepreneur, somebody that is self-employed that does not get paid on a W-2, I'm mentioning disability. If I talk to a dentist and they lose the ability to use their hands again, can they work on my teeth anymore?
No.
They're done. Did you know that doctors, dentists, attorneys, there's one other person that I'm forgetting, but they're the biggest purchasers of disability insurance. Surgeons. They're the biggest purchasers of disability insurance, because if they go down, how are they going to pay the bills? Make sense, you guys? So that's a biggie. Disability is a biggie. Number 2, which I would argue is the absolute most important, is illness. Illness is heart attack, stroke, cancer, ALS, blindness, amputation, heart transplant. I mean, the whole gamut of critical and chronic illness. I passed out a brochure that is living benefits, okay? This brochure is normally our crutch to this illness sector, okay? If you turn to page 10, there's critical and chronic illness. Critical and what?
Chronic.
Chronic, all right, I got 80% of you guys. All right, cool. So critical and chronic illness. If my client is a W-2, they have a job, they've had a job for 6 months, or they've had a job for 16 years, they have disability built into their W-2 payroll. Did you know how much? Anybody?
No.
Roughly 60%. So if I make $100,000 a year on a W-2 and I go down with the disability, I can't work anymore, I'm getting $60,000 of what I couldn't live on $100,000. Make sense, everybody?
Through their employer?
Through their employer, through payroll.
Until they get back to work?
Until they get back to work. So imagine you go down with a stroke. You can't use the left side of your body, and you definitely can't work. And your job puts you out on disability. Now you're paid disability $60,000 a year, but you can't live on that. Your bills are more than that. So do they need income protection, mortgage insurance on the illness side? Absolutely. See how simple this really is? Okay. So the secondary part of income protection is illness. On the left side, this is chronic. Okay. Right here, these 6 ADLs. ADL stands for activity of daily living. So if I lose the ability to bathe myself, to clean myself, to transport myself, what else do we have here? Toileting, eating, dressing, continence, which is cleaning yourself, and bathing. If I lose 2 of my 6, I now have a living benefit that kicks in on the chronic side. Isn't that kind of cool?
Yeah.
We had a client have a major heart attack. It was a severe heart attack, and they got close to $1 million accelerated benefit, and they did not have to die to use it in a life insurance policy. We had another client. She had throat cancer 8 years ago. That was severe as well, and she got a big percentage of her insurance policy. Will she lose her business, lose her house, lose her car, lose her marriage? No, not financially, because she's anticipated to overcome that objection. That's on the chronic side. The critical side are all these bullet points right here. See that? So the critical side are the big three, I call them. This is heart attack, stroke, cancer, okay? All you really have to do uncomfortably is get their permission to ask uncomfortable questions, which is what I normally do. Mr. and Mrs. Potential Client, during the course of the next 20 minutes, as I explain income protection and some financial benefits to you guys, I'm gonna be asking you some questions that may be uncomfortable. Can I get your permission to ask you those uncomfortable questions? That way I can make sure that I bring up a valid point here and there. Would that be okay? And once they say yes, the gates have opened, okay? If I ask any entrepreneur, hey, do you have a family? Yeah, I got a wife and kids. You love them? Okay, awesome, terrific. So if you go down with a stroke tomorrow, what's your stroke plan? And I get stone-faced about it because I'm about to make a big difference in their life, and I'm very serious about it. I ain't joking at that time because it's that serious. It's a little bit different from the real estate side, I gotta tell you guys, because real estate, check out the vaulted ceilings. Look at the swing in the backyard, it's awesome. Oh, yeah, we can include that. Don't worry about price. Price isn't the issue. It's whether you like the house or not. I'll stand on my head just to make you an offer. With insurance, it's like, hey, bro, this is serious, isn't it? Yeah, it is. We have to budget for it. What's more important, sushi on a Friday night or your family? You spend 120 bucks on sushi, but not $100 on insurance? Come on. You got insurance on your cell phone, but you ain't got insurance on you? Come on. So I get real serious about it at that particular time. Then I joke around a little bit, okay? So on the critical illness, fact number one, if you want to write this down, 39% of Americans, whether they're male or female, will have cancer in their lifetime. I have a 4 in 10 chance of having cancer in my lifetime. Now, do I want to go, oh man, it's not going to be me? Absolutely, I think it's not going to be me. But I'd rather plan for it. I'd rather have it and not need it than need it and not have it. Does that make sense? As we dive into the numbers of this insurance policy, this is exactly how I'm explaining it to them, okay? So I will come up with like a post-close, if you'd like me to, a questionnaire. And during that signing part of it or getting a listing part of it, because this is a value proposition. Hey, we're not just concerned with you buying, selling, or investing in real estate. We're truly concerned about your family as a whole. This is a generational business to us, if this is the truth. I'm not just concerned about getting you a bottle of wine on the closing. I'm more concerned with setting your family up properly for the next 30, 40, 50 years. Legacy. Make sense? It's a value prop. There's no other real estate group that's doing that, by the way. I know of one, and we're in their office, and there's no other value proposition being explained. Instead, it's the big gossip is, oh my gosh, interest rates are high, so our business is down. Our business ain't down. Pivot. Be more concerned about the client in this scenario, okay? So if they were to go down with a heart attack, stroke, or cancer, we have that to shore up the weakness. I'm going to show you an illustration in a second to cover that. Yes, ma'am.
Is there like a health check or requirement on the coverage?
Good
Is
question.
there a medical?
Good question. This is getting into the weeds, but I'll answer that question now since it's on your mind. There's 4 different reports that the insurance company is going to run, okay? Number 1 report is going to be MIB. That stands for Medical Information Bureau, okay? So you walk into the doctor, the nurse normally has like a little iPad and they're punching in different details, aren't they?
Yeah.
So you smoke, you don't smoke, you have these, that, what's your, what's going on? What hurts you today? So MIB also reports from recent declines. So if you got a decline 3 years ago because you're 5'8", 300 pounds, then yeah, it's gonna show on your record, okay?
How long are those reports good? Are they?
Normally 10 years, but sometimes these insurance companies are huge, so they can get information,
Yeah.
okay? So normally I coach my client and I let them know, hey, if you got something in your background, let me know now because it's probably gonna come up.
Okay.
So I tell them the 4 reports up front. So number 1 is MIB.
Mhm.
Number 2 is scripts. This is prescription drugs. So you know how Jen has gone through operations? That's on her MIB. Her prescription drugs is on her MIB or is on her script check. So if she's gotten painkillers or anybody that's on diabetes or taking metformin normally, their A1C needs to be controlled, things like that, right? Just a slight caveat, if they do have diabetes or high or low blood pressure, this is where more questions are asked. What was your last reading of your A1C if you have diabetes? What was your systolic and diastolic reading if you have high or low blood pressure, okay? What medications do you take and in what frequency do you take the medications, okay? Number 3 report, I'll get to in a second. Number 3 report is MVR, that's motor vehicle report. So if you had a DUI within a year, you ain't getting coverage. Let's just be real with it, okay? If you're on probation for that DUI, you're not getting coverage right now. So the smart thing for a good insurance agent is to wait. Do not get them a decline, then it goes on their MIB. So if you have diabetes and your A1C is at 8, there's a company that will accept you, but the day I get a decline for diabetes, that same company won't accept you.
Oh, I see.
Yeah, this is very similar to loans.
Yeah.
So what's the driving force behind loans? It's FICO, it's full doc, stated, or what type of program you're getting into. Are you going direct to the bank, or you got a broker? So our company, the Financial Architects and TFA Champions, we're a direct lender and a broker.
Yeah.
So we got the best rates and the best underwriting. We can't be beat. I challenge anybody to beat us. The local little shop here down the street, come on with it. You give me your quote and I'll give you my quote, okay? The last report that they're running is felony, criminal. I had a client call me the other day, my brother's been in prison for 12 years, can I get him coverage? No. Go ahead, okay? I believe the mark is 5 years out of prison. Don't quote me on that, but we do have specialty companies that insure, but once you're on probation or you're locked up or anything like that, which, you know, you're not loose in the wilderness, so to say, you ain't getting insurance. Well, I'm on probation, but I'm a good person. All right, tell God that. Okay, the insurance you ain't getting. You had a question.
Question was about prescriptions. I had a client who in the past got prescribed something, they took the prescription home, but they never got any refills, never took it, they didn't want it. Was there some leniency on the history of like how long
No.
they've been? No, so once it's
If it's
prescribed.
prescribed and you filled the prescription, too bad. Too bad. Well, I didn't take it ever. I never took one of those painkillers. Well, you got prescribed it.
Even if it was like years ago.
It doesn't matter, but in that scenario, you write it through 4 different companies, you do pre-underwriting,
Mhm.
you send it in, and each company will give you an offer or they'll give you a decline before you apply, okay? Don't get them a turn down. Once you get them a turn down, you just screwed.
Yeah, that's what I was wondering, if like you can call in to like the rep.
You can email me.
Okay.
Yeah, that's in our back office video. We have 3 underwriting videos in our back office. You just gotta press play. That's answered in the back office.
If they've had a turn down from, like they went and tried to get insurance somewhere else
Mhm.
and they had a turn down and you're unaware of that, it'll come up, right?
Yeah, it's gonna come up on their MIB. Okay, yes, ma'am.
Husband and wife, what if husband and wife, can one of them, based on these 4 reports,
Mhm.
can one of them get insured and then just be one person, will the one person be insured and not the other?
Yes.
Just because- Okay,
We just had that scenario.
just because.
Husband and wife applied.
Yeah,
Wife got approved at Elite, which is the number 1,
uh-huh,
and husband got declined because he didn't tell us about his diabetes, and If he would have told us about his diabetes, he'd have been good. Because I would have got him with Foresters and he would have been good to go.
This MVR one with the DUI, how long does that last? Or like, does that fall off anytime?
Every
soon?
company's different.
Got it.
So there is a specialty company that will approve after 1 year of
It's been,
DUI conviction. Thank
got
you.
it,
And they're not going to be approved at like elite.
of course.
They'll be approved at standard non-tobacco, which is fourth best.
Okay.
What about pre-existing conditions?
What, like diabetics type 1?
Or
They're born with it?
Heart issues
Heart issues.
or,
Again, everything needs to be put through underwriting.
got it.
Again. So I had a client that had a stent in his heart. He got preferred non-tobacco, which is second best.
Oh,
So a stent doesn't mean you're going to die. It just means you're taking care of the problem. And that's another thing to express to the client is, hey, because I have half of you guys that are my agents. So, hey, I have a client that is, or once the client doesn't disclose, that's when you're really doing them a disservice. So in your closing sheet, you should have like a one sheet and don't be embarrassed to do this. Write down exactly what you need to talk about. Bullet point here. Do not lie to me. Mr. Client, Mr. Client, I want to get you, I'm on your side. I want to get you insurance more than you want to get insurance. Trust me. Anytime I get paid, I'm good to go. So you got to tell me everything that's wrong so that I can try and overcome that challenge in the application. That's how you tell them. I want to get you covered. So anything if you tell me something, I'm supposed to put it on the agent report, but I may miss it. You know what I mean? Hint, hint. Okay? So put that as a bullet point. Another bullet point would be the 4 reports, of course. Another bullet point would be exam. Please have a seat. Another bullet point could be a bunch of different, like thank you cards or your client appreciation night, things like that are very important. Okay. Let's get into quotes. So I shared an application with some of you guys, and Jen, I even put it on your phone like I think months ago. Who airdropped me something?
Me.
Oh wow.
I'm out of storage.
Unbelievable. All right, so
I can believe it.
do I look good or what? There you go. Okay.
You can find it.
All right, so I can send this to you guys whenever you'd like me to, okay? So, and then lastly is unfortunately death. They meet their maker prematurely. So there's 3 types of income protection. There's 2 types of mortgage protection, okay? What are the 2 types of mortgage protection? There's term and there's permanent. There's term and then there's permanent. So if I go down with a heart attack, stroke, or cancer, and I want an accelerated benefit attached to my life insurance policy, I can get it for $80 or I can get it for $350. Well, what's the difference, Manny? Term is like renting. You guys are realtors. Permanent is like buying. Not everybody can afford permanent, so get them a term policy. Quite honestly, 7 out of 10 people in the United States should have term insurance. And that's a rough estimate, okay? Just get them a little term insurance policy, insure their mortgage. It's $80 a month-ish. There's been scenarios where it's $25 a month, and get them the proper coverage, which is the most important part. We'll get into that in a second, okay? So death, unfortunately, is a reality. I don't know if you guys have researched this, but we're all passing away at some point in time in the future, okay? It's inevitable. But jellyfish are immortal. I don't know if you guys know that or not. So a jellyfish will live infinitely. You ever wonder why they dive deep down into the ocean and they come back with another strand of arm? Something is in the ocean, all right? I'm figuring it out. I'll let you guys know when it comes to it, okay? 72% of the world is covered in ocean. So.
Faster cell regeneration.
I took the medication years ago. I was part of this anti-aging experiment, but I'll share that with you later in another presentation. All right, so you got your attention, right? So I'm focused on macros. We're good. All right, so you guys get it. The 2 different types of mortgage protection are term, which is temporary. It's like renting, and then permanent, which is like buying. Okay, term expires, which I'll show you in a second. Permanent does not expire, it lives until you pass away, okay? So there's 3 different types of income protection. There's disability, illness, and unfortunately, death. So whenever I'm talking to a client and they ask me how much insurance should I have, I send them a YouTube video of ours. That is The Financial Architects. We have a YouTube channel. And I know that TFA Champions is building out their YouTube channel as well, so that the agents can be comfortable in just sharing a video, okay? So if I'm talking about that, the one gauge that I'm absolutely listening to is how much insurance should I have, okay? There's an acronym called DIME. DIME. This is an acronym to explain how much insurance they should have, okay? DIME. And if you guys missed this, it's on our YouTube channel. D stands for debt. Debt. I stands for income. Income. M stands for mortgage. E stands for education. But if I'm just talking about mortgage protection, I'm just taking down what their debt is. Make sense? This is just going to cover your mortgage. So the secondary question that you want to ask your potential client, for those of you that are insurance people in here, is, did you want to insure your mortgage only in mortgage protection? Or did you also want to insure your income and education, little Johnny going to college, the afterlife party that you're going to have with doves and mariachis and all these different things inside of your funeral? You know, are you hiring like Tony Robbins to come give the eulogy? You know, all these different things that you're going through whenever you're talking about the celebration of life. So in the effort to keep it timely, I'm just going to talk about the debt of the mortgage insurance, okay? What was your name, miss?
Tina Louise.
Tina Louise, okay. So Tina, the last escrow that you closed, was it a husband and wife?
No, it was a foreclosure seller.
Okay. Who bought it?
Investor.
Awesome. All right. And the investor, on that note, okay, investors have gobs of money, right? They also do construction loans. They do a bunch of different things. This is a slight caveat. All right. They're really interested in the insurance side because they have a chunk of cash and then they have somebody that is the genius behind it, right? Or they're the genius themselves. What happens if they go down? They don't want to separate hands with all their cash. They'd rather get an insurance policy, okay? So slight caveat. But let's deal with the husband and wife. The last husband and wife that bought a piece of property through you. Tell me about the property.
$1 million doctor, young couple.
Okay, so they have $1 million of loan.
Correct.
And how old are they?
Early 30s, late 20s.
Let's say he is 32 and she is 29. How's that? Sounds good. So Dr. So-and-so, my goal here is not just to impress you with the real estate professionalism that I'm exuding out of my pores right now. My job is not to impress you with my hat, which is beautiful, by the way. My job is to give you the utmost service, but I'm not just here for the next 30 days to try and sell your property or get you into a listing, okay? My job is to keep you on the 30-year path, 40-year path of your family. I know that you have little ones. I know that you have a lot going on. I want to make sure that 2 things are covered. Your probate protection, and number 2, your income protection, mortgage protection, okay? So do you have a living trust, Dr. So-and-so? Yes, no, or I have no idea, okay? Do you have income protection, mortgage protection? So if you go down and your $1 million of debt, your wife inherits the $1 million of debt. Do you have a plan that will pay off the mortgage? They say no. Terrific. I'd love to introduce you to a mortgage protection specialist, Julie, and then Ole. Okay, she takes it from there. That's it. Super simple. Okay. If you guys need me to script it out, I'll write it out. I'll put it in a YouTube video. It'll be quick, 45 seconds. I'll make you sound like a freaking stud by the end of the transaction. Make sense? So we have this scenario, just to put you more in the weeds. So I have $1 million of debt for a 32-year-old dude and a 25-year-old or 29-year-old female, okay? Now, if I just want to protect the mortgage, you see the screen that I'm sharing here? He's 32 years old. It's $1 million death benefit. This is just term. Super simple. And, all right. If you don't have this on your phone, I can share this with you on the phone too.
You're the Wi-Fi.
Okay. Yeah, I'm on Wi-Fi. Just takes a minute, I guess.
Even the app's running slow.
Really?
Yeah, because I'm going on it.
This is the simplest one. There it is. So if they have a 30-year mortgage, by the way, my belief is more than likely we're gonna have like 60-year mortgages with the way the values are going, okay? And I'm okay with that because I want economics to go up just as much as anybody else does. But I want to anticipate to overcome the objection in the future, okay? If he's in great health, let's say he's 6 feet, 192 pounds, okay? He's probably getting rated at $57.40 for a 30-year term.
Oh, wow.
Affordable, huh?
Yeah.
So Dr. So-and-so, this is mortgage protection, covers you for 30 years. Your wife doesn't have to worry about you passing. Not to mention, if you go down with a heart attack, stroke, cancer, ALS, blindness, amputation, heart stuff, that $1 million, you can pull out a percentage of the $1 million tax-free to get you over that sickness. For $50. Who would not do that? That makes no sense, right? $50 to this guy, he spends that at lunch, right? So this is through Corebridge, by the way. Corebridge is worth almost $400 billion cash and assets, all right? Prudential is worth 1.4 trillion with a T. So these are some very large companies we do business with. 35-year, if he wants to extend it even more, is $70.74. Let's say he's 6 feet, 250 pounds. He's a little heavy on his feet, right? He'd probably be approved at Standard Plus. Make sense, ladies and gents?
Yes.
The rating is all the way at the top. The years is right here at the left. And then all the specifics of the client is right there. Well, Manny, are you in all 50 states or what states are you in? We're in all 50 states. Can we take an application over the phone or do we have to be in person? Over the phone. Can we do Zoom and explain? Absolutely. It takes about, honestly, 20, 30 minutes to explain the insurance options and then another 15 minutes to take an application over the phone. It's that quick, okay? The approval underwriting process probably takes about 2 to 3 weeks. Yes, ma'am.
Say they buy this house and they stay there 7 to 10 years, sell it and buy a new one. Do they have to reapply for new mortgage
Love
insurance
that
or is
question.
that transferable?
So just so everyone understands this, mortgage protection in the past used to be linked to your bank. Your beneficiary is his wife. So she doesn't have to refinance the insurance policy when they decide to move, leave it there or buy up or buy some units or whatever the case may be.
So it'll transfer, I mean, it's theirs. no
It's
matter
never
what.
changed.
Okay,
So let's call him John Doe. Jane Doe is the beneficiary for the next 30 years.
okay.
Now, can John Doe change the beneficiary? Let's say they get a divorce or anything like that? Yes. They can change it whenever they want to.
Second question, it says 0 to 64 years, so if they live in that house forever and they're 70 and he has a heart attack, it's no longer viable?
That's on application. Good question. That's on application. So let's say the client is 67 when he applies for insurance. The living benefits aren't there. But let's say he applied when he was 32
Right,
and he lives to be 70, they still apply.
okay.
They're still intact. Good question. Yeah. Again, every company is different. Like Corebridge, if you get up to $1 million of coverage and you're under the age of 50, I believe, no medical. Blood, urine, step on a scale, blood pressure, you don't need it. It's kind of cool, right?
Yeah.
NLG, LSW, up to 3 million. So no blood, urine, step on a scale, nothing. It's kind of cool. Simplified underwriting. Let's do the female now. So normally, just so everyone understands this, normally the wife can only get half, if she's a homemaker, she can only get half of what the death benefit is on the husband. If she works, she can get, and if she's younger, she could get up to 20 times her annual income. If she's older, past 40-ish, she can get up to 12 to 13 times her annual income, okay? The thinking behind that is they have more years to make more money, okay? So in her illustration, normally I have all my reps run the illustrations themselves so that they can know how to do it. 30 years, $25 a month for $500,000. See on the left side? So let's say husband works, he brings home the bacon to the wife and the kids. He's gonna get $1 million. The maximum she can get is $500,000 if she does not work. She's a homemaker, okay? Any questions on this? This is really easy, right? This is like bone simple. The secondary type of term is return of premium term. This is where you get back all your money. And normally it's double the cost of the 30-year term. So if the wife wants a $500,000 term policy and she wants to get all her money back at the end of 30 years, it'll be $50 a month, which is $600 a year, which after 30 years is $18,000. They'd get a check in the mail for $18,000 if she did not pass away. If she passes away within 30 years, she gets $500,000. If she doesn't, her family gets $18,000, all the money back. Okay. So if you're in the audience and you're asking yourself, well, why does the insurance company do that? What's the incentive for them? They take your money and they make money from it.
Yeah.
It's leverage. Everybody wins though. It's all good. I'm in a win-win. So introducing permanent insurance when it comes to investment grade insurance. Okay, so that's term. This is permanent. Now permanent, let's say the doctor says, well, term's cute. I have it through my job and my group at my job insures me for X amount of dollars. Okay, cool. I want to see more of your investment grade insurance. Again, majority of the time, 3 out of 10 people are investing into permanent insurance. If they have like $300, buy term and invest the difference in a mutual fund or a Roth. But if they have more than $400 or $500, yeah, they should probably look into permanent insurance. I'm not in the business to squeeze every penny out of a client just so I can get a bigger commission check. All right. Look at that. They got a list. Like them.
Why?
85 Rex right there.
Oh.
Oh. So let's use the doctor as the example. Well, Tina, you want to be the example?
No.
Okay, awesome. Terrific. I'm going to use your doctor as the example then. We'll just name him valued client. Let's just say he's 32. And let's say he's second best. He's 6 feet, 220 pounds, let's say. He doesn't smoke, it's non-tobacco. And he still wants $1 million of coverage. Just so you guys know what I'm doing, I'm blending the coverage and I'm giving away, or I'm blending coverage so I take away commission from me. Okay. In the loan world, you know how you can charge 3 points up front and a rebate on the interest rate?
Not
Yeah, it is.
anymore. 10 years.
Well, because everyone got educated, right? I mean, it's been years, but there's a reason why people got educated about the damn stuff. So here in our business, it's the same thing, but it's hidden. It's pretty wild. Matter of fact, I'm just gonna put $1 million first. This is full commission, okay? And let's say I go, this is how I sell it to the doctor, okay? Doctor, In your left pocket, you save money, don't you? The doctor says yes. What's your discretionary income every month that you put into your bank? Left pocket. What's he gonna say?
Probably nothing because he has those school loans.
Big student. loans.
Yeah.
Let's say he says 1,000. He deposits 1,000 above all of his debt to put into Wells Fargo. That's his left pocket. In the right pocket is an alternative. Okay, Doc? The left pocket, what's the rate of interest you're getting at Wells Fargo?
Yeah.
Close to zero, right? In the left pocket, if you go down with a heart attack, stroke, or cancer here in the left pocket with Wells Fargo, how much will Wells Fargo give you and your family? Zero. In your left pocket with Wells Fargo, the $1,000 you're putting into the bank, what's your death benefit that Wells Fargo's giving you above your 1,000 at a 0% rate? Nothing. In your right pocket, you're gonna get a 5 to 8% historical rate. In your right pocket, you have living benefits, which is heart attack, stroke, cancer, the big three. And in your right pocket, when you die, your family gets your death benefit plus the cash value plus the interest rate inside. These are all true facts, okay? Which pocket would you like to put your money into? The doctor's gonna go, right, if you can afford it, okay? If you can't, again, get them a term policy. 70% of people should have term. So $1 million is going in as death benefit. He's putting $1,000 a month. And let's say he puts 1,000 in until maturity. I'm almost done, guys. So this is his outlay. You see where it says 32 years old? $12,000 a year, which is $1,000 a month, minus fees equals $88.78. Make sense, you guys? So the death benefit is all the way to the right. Oops, put 1.5 million, my bad. Hold up. Let's get it right. I'm gonna print the full illustration. And I'm gonna break down fees. Again, term or permanent? This is permanent. If you want both options, no problem, I got you. By the way, with that said, there's some of you guys that want to be analysts. You get analysis paralysis. Don't do that. The local Primerica agent is going to sell them term because that's all they sell is term. The local WFG guy is going to sell them IUL because that's what they make the most commission on. Everyone's trying to sell your client something. It's sad. What I do is I do something called menu sell. Anybody eat at a restaurant lately? Yeah? You open the menu. What if they only had chicken? That's all you're eating. Would that be the last restaurant you go to that just sells chicken? But what if they had chicken, fish, they got burgers, they got steak, they got a bunch of options. I menu sell. I got term and permanent. Which of the two would best interest you on the mortgage protection side? I don't know, give me both quotes. I got term, it's gonna cost you $50 a month. I got permanent, probably gonna cost you $300 a month. But if you wanna put more money into the permanent, you can invest more money into it. And they show me illustrations on both. And they go, I want term. Okay, cool. If you give them the option, no one's gonna steal your client. If you don't give them the option, the agent that comes and peddles insurance to their house 3 years later, they're gonna tell them that you're the worst person because they sold you this and that. But when you menu sell, you never get accused of being a bad person. Make sense? The client made the choice, not you. All right? So after 5 years, the doctor has $50,000 built up in cash value, but after 5 years, he's invested about 60 grand. So it's about $10,000 in cost. But the longer you go, let's say he has a child and his child is 1 year old. By the time they're 17 or 17 years later, you see how he's 48? He's got how much? 278 grand, right? If you wanted to, he can take now 90% of the 278 and use it as a college fund for the kid.
Oh, wow.
Okay. Do I ever have to pay that back? No, you don't. It's tax-free and interest-free as it comes out. If properly structured, these are great plans. If horribly structured, these are the worst plans you could ever get into. Okay? God forbid he passes away, his family gets $1 million all the way to the right. You see that? You will always get the death benefit plus the cash value in both options. Option A and B, that's another training thing that we have to do. We are having a 2-day crash course next week, by the way, for financial planning. 8 hours each day on the 20th and the 21st. It's $300 that we're charging our agents. Our time is worth money. So you see how long-term, let's say none of that, let's say they do a flip. I have flippers that do these plans. They invest for 15 years. They have $225,000 and then they grab 100 grand and they put it into a real estate purchase. Then with the profits, they put the money back into this because the interest rate is always growing. Make sense? Okay. Let's say none of that happens. They didn't invest in property. They didn't use it for little Johnny's college fund, nothing like that. And by the time I'm sick, or doctor is 66, he wants to retire. He's got $1.2 million in cash value that he could pull from. He could put it into an annuity. He could buy a practice. He could get his dream home on a down payment at that point because it won't be worth 1.2 million anymore. So all these different things that are associated with this plan. Does that make sense, ladies and gentlemen, so far? I'm rushing through this to keep you guys on time. The last part I want to show you is these living benefits right here. The living benefits is the closer for me. And I'll tell you what, I own a business. I still make about 30% of what I take home annually is based on what I make. Me. I still close business. I still transact business, okay? I have a book of business of, 2,000 clients over the past 20 years I've been doing this, okay? So I'm pretty valuable in my own eyes, okay? If I go down with a heart attack, stroke, or cancer, that's literally the only thing. If I'm healthy, I'm good. I'm navigating the ship. I'm telling jokes. I'm like, hey, what's up? Yeah, I'm doing these things. But if I'm not, I need money. So if, God forbid, I'm 55 and I go down with a heart attack, stroke, cancer, I can pull up to $800,000 from the $1 million death benefit. Illness. Don't have to die to use it.
So let's just say at 55, I pull the 800 and then I die at 56. Well, not me, but my husband.
Mhm.
And so then the benefit at the point, then the life benefit at the point would only be the 200,000?
No, good question. Once you decide to take all your living benefit,
Uh-huh.
the policy's done.
Okay,
That's enough.
Yes.
okay.
Now, what if you took half of it though?
You get the other.
Half of everything.
Then proportionately, you get the other half on death benefit, okay? Again, these living benefits are really because you need it. Of course, no one wants to grab it, but I'd rather have it and not need it than
Yeah.
need it and not have it. Remember the term illustration that I showed you guys on the $52? The same living benefits apply. It's just not permanent. So I'll tell you a brief story. I have several stories that I can tell you about clients wanting this stuff long-term. I have a client who, when they came to see me, they're 58. They decided to get a term insurance policy, or excuse me, to keep their term insurance policy that was going to expire in like 8 years, okay? He says, I'll revisit it, etc. Ends up having like some thing, I think it was like a TIA stroke or something like that. 3 years before his insurance was going to expire. Can he get insurance anymore? Nope. Nope.
Mhm.
So again, be proactive with this stuff. Research it, look into it. You know, this is more major than anything else, in my opinion, when it comes to a client scenario. There's going to be a lot of There's gonna be a lot of clients that will sit there and try and dissect the numbers. Again, just keep it term or permanent, which one you want, and then give them the numbers, let the chips fall where they may. I have another client, they're moneyed up. They got, not moneyed up, these are regular people. She was a nurse. I do these dinner seminars. So if you guys are north of 55, you get these coupons, these dinner seminars in the mail. And I have tons of clients that come from those dinner seminars. So I had a senior, husband and wife. She was 68. She was a nurse. She retired about 3 years ago. And then he was an engineer and he was 69. They probably have about 1.2 million in their IRAs. They have 2 paid off houses, okay? This is real life stuff that happens, okay? They have no insurance. They go, well, we didn't need insurance because we saved all our money, etc. I'm like, oh, thank God for that. We had group term through our work, etc. I go, well, that's awesome. I said, when you're 75 and 80, do you want your kids coming to take care of you like a nurse would? And they both looked at each other and go, hell no. My wife used to be a nurse. And she goes, no, and they were Filipino. No, we needed this, we needed that. And as a nurse, I see what happens. And she hit, she calls him dad. And she hit him, she said, Dad, we need something like this. And so I gave them the permanent coverage and it was really expensive. I mean, $1,500 a month, but they could afford it. So they decided to take advantage of it because of the cash buildup in it. Make sense? Now at that age, that brochure explains no more of the living benefits. So they still wanted it on the overflow of cash flow. So age, when you do it, is really important, you guys, really important. And I can't stress that enough. These living benefits are somewhat new too. They've been around for about 13 years now. That's it. So a lot of your clients have the old type of insurance where you have to die to use it, not the new stuff. Okay, I made it quick to the point no fake can. Any questions? No questions, a dumb question? No?
I just have an idea. But
Awesome.
It's for you girls, for you guys
Oh,
to
awesome.
bring in more business.
There you go. I'm into ideas. Did I went a little bit over.
You did.
Did you guys get a lot out of it? Good?
Yeah, it was very interesting.
Great. Couple of brochures that I gave you guys too.
Client that's buying right now, a police officer, what if he gets shot on the job, what does that fall under, illness, disability?
Most police officers have $100,000 worth of death benefit through their department,
Oh, okay.
which is
Only if the death happens on the line.
on the job, right? And that's $100,000. Yeah, it's horrible. They have great pensions though, and they have really good deferred comps. They have 457 plans, but those
So they
457s,
need something like this, you don't?
they do.
Oh, they
Yeah, over the top.
Depends on the department too, because, it just told me that their department, I think, is only $5,000.
Wow, it does depend on the department, yeah.
Yeah.
So her husband's a cop for Southgate PD. But this is major value for your clients.
Yeah.
And the second piece,
Yeah.
if you guys need any of these, or you want a stack to give away to your clients, like one by one, of course, let us know, because we just ordered these from the company. This is a really good brochure. It's called Home Sweet Home. It talks about how all of these dramatic things could happen, and it's really important that they insure their home. Mortgage protection, right? Everybody needs it. That's it.
I think this was real, oh, go ahead. Did you want to say? I think this is really a great class, and it's pretty, like, it was simplified, right? Like, simple to understand. I would like to, I know that we got it on Pulse so that people could do the replay, but I would like to do another in-person in January
Okay.
when
People
everybody
back
is not
door.
on vacation.
Yeah.
And we can get a lot of agents in and then go over it again, because I think this is really, really good.
Yeah, me too. And I'll make it more streamlined. I don't really like slides. So if you notice, when I do mortgage protection, I I don't do slides like, hey, these are the different bullet points. I'm more interactive, like I want to show scenarios.
Right.
So I think that'd be great for January. Matter of fact, we could even have like a kickoff meeting at a hotel, and I'll make it a full TFA thing. And
That
I'll
would
go
be
through
good
it.
too,
Yeah.
yeah, we could invite.
Because I could literally go through like,
However it is to get all of this info out, it was really good.
because this will
Super
get you more
beneficial.
clients too.
Yeah, and I mean,